we're going through a consolidation period right now. So as I mentioned last time I was on, we were heading into August, September, which are two traditionally weak months for the market. But considering the gains from earlier this year, we're just consolidating and digesting in a range. Think of it as a big Thanksgiving meal. After a big meal, you just want to digest and lay on the couch. We've had a great gain in the first half of the year, and I think it's normal price action to consolidate those gains. Now, coming out of this in the fourth quarter, I'm expecting the market to break out of this range higher for four reasons: technicals, fundamentals, interest rates, and sentiment. And I'm more than happy to talk about any of those.
So let's go through that. You have a four-pronged approach to why the bullish markets are going to continue.
Yes.
Take us through the fundamental reason why. Are valuations attractive? Is the growth picture doing better? Are corporate profits growing better? What's the crux behind the fundamentals?
Yeah, the fundamentals, I mean, earnings have definitely slowed from last year, but we're still growing at a slow and steady pace. Some sectors better than others. If you take out energy and some of the manufacturing, other sectors such as technology, housing have doing better. But this 10-year recovery, everyone seems to think it's going on for too long, but it's just been slow and steady at a 1% to 3% growth rate, and I think it can continue at that level. So fundamentals are still strong.
We've been flashing a lot of charts for our viewers out there about various parts of the market. Charts are things that you look at as well.
Yes. You
mentioned technicals. What's the technical setup like for the market right now?
The big institutions control the market, and they continue to support the market at key levels. Throughout this entire year, the volume has been strong. I pay attention to what they're doing, and the volume's been strong and very, very supportive. There's an interesting statistic that the first half of the year, the first 6 months, stocks and bonds were up over 10%. That's only happened 10 times since 1970. And going forward, 6 months and 12 months, the market respectively has been up on average 11 and 19%.
Prong number 3, interest rates.
Yes.
How does that set up now?
We are in a globally coordinated effort to keep interest rates low and the markets high. A lot of people argue with that and are not happy with it. But interest rates, when they're low, it can justify a little bit higher valuations and can justify, I mean, there's a lot of liquidity out there. So it actually is a good environment and market friendly for when interest rates are low.
Just a couple seconds here. Sentiment, why?
There's a pattern when the market goes up, people get a little bit too bullish, and when the market comes in, the interesting part is people rush for the exits very quickly because no one wants to. They think the market's gone on for too long, and no one wants 08, 09 to happen to them again. And the market tends to fool the majority. So when everyone's rushing for those exits, the market tends to stabilize, and then we rebound as we've seen, here and there in August.